Hi, Mariam. Just checking you can hear me properly.
Yes, I can hear you.
Can you hear me?
Yes.
Good morning, everyone. It's 10 o'clock, so we'll make a start. Thanks for dialing into our Tax Matters monthly webinar. The aim of these webinars, as a lot of you will know who've been joining us for the last year or so, is to just give a very brief overview of any significant issues and announcements that have taken place over the last month since our last webinar. We held a special webinar for the VAT rate increase last month, and this obviously supplements our weekly tax flash emails that are sent out every Thursday afternoon. I know some clients were for some reason not receiving the tax flash. If you're one of those people, then just reach out to one of the team members and we'll make sure you're added to the mailing list. Your presenters today are Raman Ori and myself, Tarek. I'm one of the senior managers in the tax team, and Raman is one of our executive managers in direct tax. He leads the direct tax practice. George Campbell, obviously most of you will know, he's our head of tax, is unable to unfortunately attend today due to unforeseen circumstances. So me and Raman will be sort of taking the lead on that. Just so that you know, we want Tax Matters to be as interactive as possible. It's easy for us guys to talk for 45 minutes. But that's not what we want. What we want is a bit more of a conversation. So if you have any sort of questions, feed them through the Q&A widget. The widget will either be on the top of your screen or on the bottom of your screen, depending on how your system is sort of set up. And if you ask any questions, what we'll try and do is we'll try and answer them as we go along throughout the webinar. It may be the case that some questions are a bit more difficult, and we'll have to spend a bit more time thinking about them. But in any case, what we'll do is we'll share a PDF of the slides and a summary of the questions together with the answers over the next couple of days. So just moving on to increase in Bahrain's sort of standard rate of VAT. We obviously talked about this significantly last month. There's not been much of an update on the VAT rate increase expected to take place from the 1st of January 2022. At this moment in time, there's no reason to believe the increase won't go ahead, won't be approved by the Shura Council and the Parliament. We're probably expecting some sort of announcement over the next few weeks. I've actually seen some reports saying that VAT's already been affected from the 1st of January 2022. As far as I'm aware, that's not the case. It's still waiting for approval before it goes ahead. And look, if the standard rate of VAT does increase, there's likely to be very little time to assess impact. So from experience, what we're suggesting is considerations can be made well up front. For example, some things businesses are able to do is review their customer type. Your customer type sometimes is you've got your taxable persons, you've got individual persons. You may be able to segregate contracts between government and non-government entities. What you can also do is check whether there's contracts in place for the supplies that you make. A lot of the times what happens is the contract is just verbal, or documentation is either not there or insufficient to demonstrate that the contract was entered into by a certain date. And where that is the case, it's going to be quite difficult to apply the transitional rules. And the insight that I'm giving is basically based on the Saudi rules. And also if you look at the grandfathering provisions, they also touched upon, input tax recovery perspective, look at your customer, even the recent, or not recent, the VAT rate increase to 15% in Saudi, you'll see that they segregated between the different customer types. So there were different rules for government entities, different rules for other entities. So that's just something to think about well up front. I've had a few clients reach out already on this, and I've already started some sort of legwork just to sort of segregate some of the data, especially where the operations are complex or where the groups, large family groups, large businesses, which obviously about 7 weeks to go till the end of the year. So they won't have much time if they wait. So they're just planning as though VAT rate will increase. So I'd suggest that other businesses sort of take that approach too, if possible. Okay, moving on to the next slide. This slide ties in nicely with the previous slide. VAT optimization will sort of, be at the forefront of a lot of businesses' minds, just because the VAT rate will increase from 5 to 10%. Not saying the 5% rate is insignificant for some businesses, it is significant. But what's important is now to just look at your operations and look at the type of supplies that you're making, because there may be ways to either reduce the net VAT cost to your business, or at least maybe plan transactions in a way so that cash flow is taken into account. A lot of times, the time of supply rules and the way the contracts are drafted lead to an outcome where the time of supply leads to an inefficient application of that sort of early on into the contract. Whereas if you sort of draft the contracts in a way where it's in line with the operations and commercial reality on the ground, sometimes it is possible to delay the time of supply, staying well within the VAT rules. So we're not talking about tax avoidance, tax evasion here. We're just talking about sensible tax planning. I had a recent case where there's an insurance broker was collecting, for example, a premium on behalf of an insurer. And then what they would do is they would deduct a percentage commission before passing on the remaining amount to the insurer. But the amount that they received, it was sort of questionable whether it was really earned at that time, because they had the money in their bank, even though they couldn't use it, because it wasn't confirmed at that point the exact commission amount, although it's expected to be at 10%. So, what we've suggested them to do is maybe move the money directly from the insurer, the insured party, directly to the insurer, and then get the commission thereafter once it's been finalized. So that's just a small example of, time of supply management. I've done a lot of work around retention type payments. This normally applies in the construction trade. A lot of the times retention payments are taken up, the time of supply is triggered well up front, but there's sometimes scope to draft, contracts in such a way so that the supply is not disadvantaged. Obviously, there are 12-month time of supply rules in place, which, stop over planning, but even taking that into account, there is sometimes benefit in looking at what's the current status. For VAT grouping, I've seen a lot of clients do VAT grouping. I've seen some clients go for VAT grouping just because I think it's always beneficial. Had a recent client where they VAT group, but a lot of their entities were exempt and some were taxable, but the large majority were exempt. And it was questionable whether VAT grouping was actually a saving for them or whether the residual tax was leading to a poorer recovery of VAT. So we're just currently assessing whether they should maybe come out of the VAT group. So it's not always, I know when people hear VAT group and say, oh yeah, there's going to be saving, it's not always the case. You really got to look at whether you're able to attribute some of your expenses to taxable supplies, whether you're able to attribute directly to exempt supplies, and then look at what's sort of left out in the pot and take it from there. Okay, what I'm going to do now is pass it on to my colleague Raman, who's going to talk to you a bit more about economic substance.
Good morning, everyone. Hope you're all well. Over the next few slides, I'll be talking you through some of the tax updates of late. So we begin with the economic substance rules, both in Bahrain and the UAE. Now, in Bahrain, the filing deadline for the financial year 2020 was the 18th of September this year, 2021. So we've now passed 6 weeks, and what we've seen is the Ministry of Industry, Commerce and Tourism, the MOICT, has been very proactive in issuing CR violations to those businesses who were required to file returns but haven't done so. Moreover, in some instances where the businesses have filed the returns, the MOICT is asking for additional information, particularly in relation to connected or related persons, such as UBO, UP, or IP. Consequently, my recommendation to businesses who haven't yet assessed whether they are required to comply with the rules or who haven't filed a return, to do so at the earliest possible time so as to avoid such punitive action, which could also mean financial penalties for the business. With regards to the UAE, the filing deadline for the financial year 2020 was, well, there are actually two filing deadlines. One is to file a notification, which was supposed to be filed by the 30th of June this year. And the actual filing of the economic substance return or report is by the 31st of December 2021. In the UAE, there are some businesses who are exempt from these rules, namely investment funds. One point to note is that the companies in which the fund invests are not exempt, and neither is the business of fund management. So it's only purely the fund itself, the investment fund itself, which is exempt. The other businesses, so for example, if you have wholly owned UAE businesses, which are not multinationals, they are exempt from the rules. UAE citizens or residents who pay tax overseas, and when I say tax, I mean corporate tax only, they are not subject to the rules. And finally, foreign branches. So say, for instance, if the branch profits are taxed in the parent jurisdiction, then the branches are not subject to the economic substance rules in the UAE. Financial penalties range from starting off from 20,000 dirhams to up to 300,000 dirhams for repeat offenders. So obviously quite significant. And just like in Bahrain, there's a risk that businesses could lose their license or the license be revoked by the authorities if they do not comply with economic substance rules. The Federal Tax Authority, the authority in the UAE, have released a very useful and handy guide for economic substance appeals. So this can be used by businesses who believe that they are not subject to the rules, but have been asked to do so by the Ministry of Finance. The guide states the circumstances around which you can file an appeal process and timelines for submissions. So that's Bahrain and UAE for you. Moving on to Saudi Arabia, the ZATCA, which is the tax authority out there, released a useful withholding tax guideline back in summer. I think it was in July this year. And it reaffirms their position on certain complicated and technical aspects of withholding tax, which were previously issued by way of resolutions or FAQs. The good thing is this guide is very useful since it has lots of examples, illustrations, and it's in very user-friendly language, whereby a taxpayer can assess and understand what their potential withholding tax implications would be on a wide range of services that are provided to them by a non-resident party. At the same time, there may be opportunities for tax planning in place so as to mitigate the overall tax impact or burden for the local business. So let's look at some of the key areas where there's been some significant changes. So I'll begin with permanent establishment. There's always been a school of thought, and to be honest, I was amongst them, that as to why does a taxpayee of a non-resident have to suffer withholding tax in Saudi Arabia. The ZATCA have thankfully clarified this now in the guide, and the guide states that a taxpayee, although a non-resident, will be considered hereon a domestic entity from a WHT, from a withholding tax perspective. And therefore, any payments made to it by a domestic entity should not be subject to withholding tax. Moreover, any payments that have been made by the domestic party to the head office directly in relation to the PE's business in Saudi Arabia is also not subject to withholding tax. let's look at related party. Now, according to the tax law, Saudi Arabian tax law, one party is related with the other if they control, or say two parties are under the control of a single entity. And when we talk about control, we are mainly talking about share ownership. So majority share ownership, which is usually 50% or more. However, what I've seen recently of late, Zadka is interpreting the relationship between parties based on the definition of effective control, which is given under the transfer pricing regulation that were released in 2018. Now, what they're saying is that regardless of the share ownership percentage, if the non-resident can control the key business decision making of the domestic entity, then that non-resident is related. This is something which is hotly being debated by the businesses and tax consultants such as myself alike, because this is only given in the guide. It actually hasn't been enacted in law, but it's important to note for taxpayers in KSA that should this become a standard practice where the Zadka not only looks at majority ownership, but also effective control, then this could mean significant tax consequences for businesses that undertake business, that receive services from non-resident parties. Many of you would be aware that when you acquire a software or trademark, on the outset, it's not subject to withholding tax, and the taxpayer would report it as an intangible asset in their financial statements. However, this guide has clarified that if a software developer has configured the software to suit the specific needs of the local business, there is an inherent service element within the purchase price, and the withholding tax on services provided in relation to software, IP, copyrights, trademarks, whatever you want to call it, is considered as royalty and subject to 15%. So a significant change here in the GAZA's position on software. And finally, where there's a contract between a non-resident and a domestic entity that has an in-kingdom service element. So for instance, if part of the service is performed inside of KSA, these services are subject to withholding tax. I mean, this is nothing new. I mean, this has always been the case, but what the guide now says is, or encourages local businesses to ensure that the non-resident is provides on their invoice a split of the services performed outside and inside. And that is actually a good recommendation from Zadka themselves, because if the price is not split in that fashion, then they reserve the right to apply withholding tax on the full amount. Whereas if obviously the price is split, then they can clearly see, and taxpayers can clearly see, what is the value attached to the services provided inside KSA and deduct withholding tax accordingly. Okay. Moving on to the next slide. Zadka has released a library of cases that have been heard by the appeal bodies. Now, there are two levels in KSA. One is the Tax Violation Dispute Resolution Committee, TVDRC, and then the upper level is the Tax Violation Dispute Appellate Committee, the TVDAC. Before I come on to some of the reasons which are on the right-hand side of the slide, let me just quickly walk you through the actual assessment and litigation process as it currently stands, because it has undergone significant changes over the past 6 to 12 months. Many businesses were accustomed with Zatka initiating a field audit before they issue the formal or the final assessment. However, in these pandemic times, what's now happening is Zatka is issuing a draft assessment. This applies to tax or VAT or customs for that matter, or transfer pricing. So pretty much across the board, issuing a draft assessment and then requesting for information or documentation from the taxpayer in order to finalize the assessment. Now, if you're lucky, you will have 2 to 3 working days to respond to this. However, our advice would be at this stage is not to panic. And if the volume of information requested is large, you can always pick up the phone to your Zatka RM, relationship manager, and request for an extension for 1, even 2 weeks in some cases. I strongly recommend that taxpayers should take this opportunity and time to review the information that is thoroughly, which will be then go on to which will then be submitted to the Zatka, because what you send at this initial stage will form the basis of a subsequent assessment that is issued by Zatka. Taking such a proactive approach at this initial stage would, in my opinion, give taxpayers the best opportunity to mitigate their potential liability. I've assisted a number of clients on similar assignments, and we've successfully managed to reduce the principal liability and penalties in some cases. The most notable one being where for one of our clients, we managed to reduce the liability by up to 80%. Moving on to once the information has been submitted, and there might be 1 or 2 follow-ups, eventually Zatka will issue a final or a formal assessment. We all know taxpayers have 60 days to respond, but what we've seen, and especially one of the reasons Zatka has given, is that taxpayers sometimes forget not to settle the tax on the amounts that are accepted. If you're a Zakat payer, you're also required to settle a certain proportion or maybe provide a bank guarantee on the disputed amounts. Once you've submitted your objections, Zatka has up to 90 days to respond by issuing an amended assessment. We now move on to sort of the litigation side of things. So the GSTC, General Secretariat of Tax Committee, recently, well, I say recently, but actually it was in September, they merged with the Saudi Customs, and now they're called the General Secretariat of Zakat Tax Custom Committees. But I'm just going to call it GSTC for ease. So what the taxpayer needs to do is, if they do not agree with the amended assessment and they have exhausted other avenues, such as maybe if they wanted to, maybe they requested for a settlement with Zatka, which was rejected. So once they've exhausted everything, all avenues when it comes to settlement with Zatka, in order to progress to the next level, they need to lodge an appeal with the GSTC for the case to be heard in front of the appeal committees, the TVDRC and the TVDAC. Once they have 30 days to lodge this appeal, so it will be 30 days from the date they receive the amended assessment, or if no response was received from Zatka, then it will be 30 days from the 90 days. So between 90 and 120 days that they need to file this request. A power of attorney has also to be lodged at the same time, giving specifically in the prescribed format and giving details of who will be representing the client at the hearing. Now it could be, it usually is the client, but it can also be the client with a third-party consultant, which could be a lawyer or a consultant or both, depending upon the complexity of the case. Okay, quickly moving on to the reasons why the cases often are dismissed or the appeal committees tend to side with Zatka. I would probably put them into 2 tranches, one from a legal side and secondly from a technical side. So when we talk about failure from a legal perspective, we're talking about taxpayer not having met the filing obligation. So for example, if you haven't filed the tax return on time, you haven't filed the objection within 60 days, settled the due tax, or you haven't lodged an appeal with the GSTC within the requisite time period, or your POA has been incorrectly prepared. Now, one of the reasons Zatka said was, unbelievably, there have been instances where taxpayers have not attended hearings without giving any reason as to why. Now, the taxpayers should be well aware that in the POA, they're required to nominate provide the name and ID and contact details of the representative. Now, that person is the one with whom GSTC will correspond going forward and notify them for all hearings and so on. So it's really important that that person is someone who is responsible, senior or high up in the organization, or if it's a consultant, then obviously the consultant would probably be well aware of his responsibilities to make sure that they monitor and track their emails and messages so that such things do not happen. And then we look at the technical side. Now, at the end of the day, your chances of success is hinged upon how strong is your counter argument to the assessment that has been raised by the Gazette. So here, I've already stressed this before, whether it is at the very initial stage of providing information to Zatka, to the writing up the formal objection and lodging an appeal. These should be well written. They should be, they should be technically strong. Reference to case law, documentation should be provided whenever requested. All these things will add weight to the taxpayer's case when it comes to the appeal bodies, because the good thing about the appeal system here is that it's in my experience, I found it reasonably fair, in that if the taxpayer has a justifiable argument and a reason for appeal and can provide all the documentations and it's compliant in every other way, they have an even chance to win the case. And we've had a lot of success with not only with Zatka, but at the appeal level when we've represented clients. And this is the common theme. It's a much fairer system, but at the end of the day, your case has to be strong. And in some cases, depending on the complexity, I would not shirk in giving this work to a third-party consultant who can obviously guide businesses through the experience they've had in dealing with the tax authorities. Well, that's about it. Probably gone over a minute or two, but I just wanted to really hone on this point. I'll now hand over to Tariq to continue with the next part of the presentation.
Thanks for that, Roman. So just a bit about e-invoicing. What I would say is we definitely expect to see Zatka audit from 4 December 2021 onwards. Based on the reviews I've done with taxpayers so far, the results are sort of starting, I think. I don't think I've seen many taxpayers that are fully compliant from the 4th of December, at least from a document perspective. So that's something definitely to look at. For e-invoicing, there's lots of rules that may appear to conflict each other, especially around invoicing sequencing. So that's something to really look at as well. And that's especially the case where there's multiple divisions, different branches. You could have a retail branch operating a POS system, or another branch using a SAP system or Oracle system. So, there's a lot of issues around the invoice counter and or invoice sequence, depending on how you sort of read the rules. Okay, and look, in relation to general audits, what I would say is this would follow the same theme. We're seeing audits conducted across the board for all industries. So, that's something that we're going to expect to sort of see continue. What I would say lastly on the e-invoicing, before moving on to the next slide, is it's just a reminder to sort of, if you're not engaging anyone to sort of assist with the e-invoicing, what I would make sure is that you're on top of any updates coming out from the ZACA. There's a technical specification requirements, there's regulations, there's FAQs. I think there's about 10 or 11 English sort of booklets at the moment. And then there's more Arabic, which have not been translated into English. So that's obviously that's something we do, but that's just something to be aware of. And just to ensure that from the 4th of December, any invoice that's generated is not as before, and it's compliant with the e-invoicing requirements. That's just something I would sort of finalize on that point. And moving on to the next slide. Yeah, amendments to the KSA sort of implementing regulations. So with the time of supply rules for government entities, they've sort of changed. They took effect from the 1st of this month. So where supplies of goods or services are made to a government body through contracts concluded under the government tender and procurement law, the tax due date has changed, and the tax due date will now be the earlier of the date the payment order is issued to the supplier for that supply, or the date the consideration is received, and obviously to the extent of the amount received. I've had some clients who are having issues in applying these rules, especially, I think we had one client recently, they have many government contracts, and I think they issue in the region of 2,000 or 2,500 invoices a month, and they want to continue with the same method as they have been doing. Just, they will account for the tax on the tax invoice issuance date. Strictly speaking, that won't be correct, because even though this is a relief, if you're a partially exempt business, there's likely to be impact on the net VAT position. And in any case, reporting is not going to be correct if the rules are not sort of followed on that amendment. So, if you're not sure about anything, I would definitely reach out. And in terms of government bodies, it's not been defined what government bodies are, but it's taken to mean, the sort of normal entities that fall within sort of the government remit. So we'll move on to the next slide. And this is around the proposed amendments to KSA implementing regulations, articles 53, 54, and 66. As you'll note, the changes are coming thick and fast. So throughout the tax world in the GCC, and it's a job just to stay on top of the updates and then to interpret and analyze updates, just to see sort of how it affects your business processes and how it affects your supplies and purchases too. So on the 27th of September, ZACA proposed some amendments to these articles in Arabic. The deadline to respond with comments has already passed. It was the 23rd of October. Some of the points, there were so many points touched on, but very briefly, some of the points were around a requirement to issue a full tax invoice. And then there were exemptions for simplified invoices. And what's been clear, I think, is the route that ZACA wants to go down is a full tax invoice won't be an option where supplies are made to individual non-taxable customers. I know at the moment, the way the rules are drafted, it's optional, and in some places where you look at ZACA guides, actually appears to suggest it's mandatory to have simplified invoices, but it's not 100% crystal clear. So ZACA is obviously seeking to just make it really clear so that you cannot, have a full tax invoice where your customer's an individual non-taxable person. And then there's some amendments proposed for self-billing, where both the supplier and the customer will have to be VAT registered. There's something around summary tax invoices. A lot of companies don't use summary tax invoices, but actually really useful. You can issue one tax invoice for supplies across, a full month. So if you have a customer, rather than issuing a tax invoice each time you make a supply, you can just send a summary tax invoice. The current rules in Saudi state, if you look at the regulations, they say that a summary tax invoice can be issued for a tax period. But then obviously tax periods are sometimes 3 months. So what ZACA wants is actually saying it should only be for a month. So they've cleaned it up. So, and there's clarifications on credit and debit notes, when they can be issued and what sort of references are required in the sort of credit debit notes. And there's sort of wholesale changes to the storage of VAT related data. That's a sort of a hot topic. And that ties in with some other legal implications as well. So that's just something to consider. Moving on to the next slide, future of the VAT in the GCC. I mean, you know, lots of people ask when, you know, when will Kuwait implement VAT? When will Qatar implement VAT? And what VAT rate will they start out at? Look, over the next few years, you know, we expect the remaining GCC member states to implement VAT. I can see, you know, based on experience, they'll probably start on 5%. They may very quickly move up, you know, 10%, 15%, but obviously we have a disparity in the VAT rates between the different GCC countries. I'm not sure which way it will go. You know, there was talks about Saudi Arabia maybe reducing the VAT rate to 10% at some point, but more recently I've seen that maybe that's not going to happen. So it's just going to be something that can change sort of overnight. And, you know, we saw that with the Saudi VAT rate going from 5% to 15%. So, you know, from the VAT rate increases, there's a lot of things to consider from system perspective, supply chain perspective. I think dynamic businesses are probably going to get a competitive edge where businesses can move quickly, you know, and source maybe supplies at a lower VAT rate depending on their sort of business model. But I think what's clear is that if another GCC member state does want to increase VAT, the road's already sort of been set out, and there's nothing sort of stopping any other member state increasing that from 5 to 10 to 15 to who knows, even 20%. I mean, it's just really difficult to say what will happen next. But what's important is finance personnel are sort of on top of the rules and on top of the transitional provisions, especially because we've seen a lot of activity around assessment of you know, how transitional rules are sort of applied. So look, that brings us to the end of our webinar. I think we're tracking, we're okay in terms of time. We've got about 8-9 minutes. We'll go through some of the questions asked and we'll try and answer as many as we can. And those we're not able to answer, we'll obviously have a think about it and then circulate the slides in the Q&As. So we've got a question on e-invoicing. It says, we understand there are some requirements that do not have to be visible on a tax invoice. What does this mean? So look, with the e-invoicing in Saudi, there's always been two pieces. There's been a tax side of it, and then there's been an IT side. Some requirements are specifically IT related. Some requirements are more tax sort of related. So when you look at an invoice, for example, if you look at the e-invoicing regulation and specification requirements, there's a requirement for the time to be on the tax invoice, but it does not have to be visible on a tax invoice. So, you know, if someone comes and audits your system, there must be a time that they can see this is the date and this is the exact time that that tax invoice was issued. The time you may, it's up to the taxpayer whether they want to make that time visible on a tax invoice. I've not seen many taxpayers choose to do that, but your system must be able to do that. So that's the visible sort of piece on that one. Okay, there's another question. Will government-owned entities benefit from the new tax due date in relation to contracts with government bodies? No, I think what's important is to see whether your contract is with a government entity. Okay. Now, if your contract is with someone other than a government entity, then the rules probably won't apply. Just because a government owns an entity, so for example, I don't know, the Saudi Ministry of Finance, for example, may own an entity. I'm not sure if that would ever happen, but just, you know, for the sake of an example, say that happened, then you would not look at the ownership of the entity. What you'd look at is who are you making your supply of goods or services to? And that will dictate the time of supply and obviously the VAT treatment in some instances as well. Okay, is there a list of government bodies provided by Zakka to benefit from a new VAT mechanism? There's no specific list provided. In our slides that we circulate, we'll give a sort of a brief sort of overview of, you know, the types of entities that are likely to be sort of, you know, applicable for the time of supply rules in relation to Article 20. Raman, one for you. Can they still submit ES returns for FY 2020 on the IES portal?
Yes, is the short answer. In fact, it is mandatory to submit the return. So, and the portal is still open for people who have yet to file the 2020 return.
All right, thanks, Raman, for that. our company imports a lot of goods. If the new VAT rate is approved, when will our imports be subject to 10%? Not if VAT rate does increase to 10%, then anything imported from 1 January 2022 is likely to be, applicable for 10% VAT. So I'm sure there's probably companies importing goods now, just stocking up. So that's maybe something you want to assess from a sort of commercial point of view, whether it's going to be beneficial. But even if you import something at 5%, any supplies you make of the same goods, if they are made from the 1st of January 2022, they'll probably be subject to 10% VAT, even where payment has been received before the 1st of January 2022, or indeed if you issue a tax invoice, just to stop people trying to, sort of play around with the tax points and to gain a sort of advantage on that side. So the transitional provisions are 99% likely to cover that. Our company is making exports only. Will we be subject to e-invoicing provisions? The short answer is yes. It's a taxable supply at 0%, so they will be subject to e-invoicing rules. Obviously, if you make an export from a third country, from outside Saudi Arabia to another third country, then it will be outside the scope of KSA VAT, in which case the rules will not apply. Okay. And the next question, actually, I've touched on upon already. It's just a quick question around receiving payment now for supplies making in Q1 2022. Should we apply 5% VAT or 10%? So if you're making the supply, which is going to take place in Q1 2022, you should be applying the 5% VAT rate. There is no reason to apply 10% just now. It may not even be approved. And then obviously if the transitional provisions do come in play, then you're likely to be able to, well, you're likely to have to account for the additional VAT. Okay. Roman, there's another question on ITIS portal, but this time it's for 2019. What's the answer on that?
Interesting. Well, I guess the short answer is yes again. However, in this case, because it relates to 2019, I would recommend that you write a letter to the ministry, MOICT, obviously giving details of the company, the relevant activities, and more important, the reason why the filing is over a year late. And I'm pretty sure that they will give you the necessary approvals for you to then go on and submit the return on the portal.
Thanks, Rahman. Lots of questions around transitional rules. Will transitional rules be similar to when Bahrain introduced VAT in 2019? Look, it probably will include some of those rules. I can't see a great divergence in those rules. And if you take the Saudi rules, the Saudi grandfathering rules, the Saudi VAT change rules, they'll probably be similar, but obviously there could be something in there that's not been sort of on the table before. So we'll just have to wait and see on that. And there's a question around the transitional period for VAT rate change for Bahrain. Look, if it does happen, then it's hard to say. It's really hard to say, maybe a year, but that's just a random sort of, not a guess, but it's just an educated guess compared to what's happened in the VAT implementation. So the transitional period may be longer in certain instances. I think it was about 4 or 5 years in some of the scenarios. So it's just something to have a look at. Roman, is it mandatory to pay the assessed zakat before filing an appeal? I think we touched upon that in the webinar, right?
Yes, we did. Yeah, if you're a zakat payer, then you're required to settle obviously the zakat on the items you accept, as well as a certain percentage proportion of the undisputed amounts. Either you settle it in cash or you provide a bank guarantee.
Roman, this is one for you. I know it's that one, but I'll let you answer this one. Is Aramco considered a government entity? Look, we're not. Look, I don't want to give an answer on that. We'll give an answer in our Q&As. I don't like giving a specific answer without doing some background sort of research. So yeah, we'll hold on to that. It's
a difficult one because they obviously have public ownership, but they also do have private. So it's difficult. We'll need to look into this and come back to you.
Yeah. And for that question, it may be that you want specific advice, because if you're trying to rely on a certain rule and you're not sure, then what I would probably do is get some written advice on that, so you have something to rely on in case what the application of your rules are incorrect, just to avoid that. And the same person's asked around the specific definition of government bodies. We'll cover that in our Q&A slides. There's no specific definition, but the application of government bodies, that term is sort of set out in some of the guides. So it might be worth sort of looking to that. And then someone wants a comment on the CBCR notification filing requirement in Bahrain. What is required to be done by 31 December 2021?
Okay, so if you're a multinational entity, you're required to notify the Ministry of Industry, Commerce and Tourism by the 31st of December as to who is the ultimate parent entity, which will have the responsibility of filing the CBCR form. If that ultimate parent entity is not based in Bahrain, then you need to provide information about what they call as the constituent entity, who will file the report on behalf of the parent entity.
Great. Look, that's taken us 1 minute over. So look, thanks everyone for dialing in today. I hope you found it useful. There's about 16 questions outstanding, but what we'll do is we'll circulate, like I said, the Q&As over the next few days, along with the slides. And if you've got any specific questions, feel free to reach out to any one of our team members, and we will join you on the second Monday of the next month for the next webinar. And until then, all the best.
Thank you.